When people start thinking seriously about building wealth, one question inevitably comes up. Should you invest in the stock market, or should you rely on life insurance as a financial strategy? At first glance, these two options seem like they belong to completely different worlds. One represents growth, risk, and opportunity, while the other represents safety, protection, and certainty. But in reality, both are often marketed as powerful tools for financial success. Some advisors will tell you that the stock market is the only real way to build wealth. Others claim that life insurance, especially certain types of permanent policies, is a hidden strategy used by the wealthy to grow and protect their money. So who's right? The truth is, neither side is completely wrong, and neither is telling the full story. Understanding how each works, what they are truly designed for, and how they fit into a complete financial plan is essential if your goal is not just to save money, but to build lasting, meaningful wealth over time. Today we're diving into stocks versus life insurance. Which one actually makes you rich? So before we begin, make sure to hit the like button and subscribe to the channel. Let's start with stocks, the backbone of modern investing. When you invest in stocks, you are buying ownership in companies. These companies produce goods, deliver services, innovate, expand, and generate profits. As they grow, your investment grows with them. In many cases, you also receive dividends, which provide an additional stream of income. Over the long term, the stock market has historically delivered returns of around 7% to 10% annually. While these returns are not guaranteed and can vary, they have consistently outperformed inflation and many other types of investments over extended periods. But what truly makes stocks powerful is not just the returns, it's compounding. Compounding is the process where your earnings generate their own earnings. Over time, this creates exponential growth. It's the reason why starting early, even with small amounts, can lead to significant wealth later in life. Imagine investing a fixed amount every month. At first, progress feels slow, but over time, your investments begin to accelerate. Eventually, your money starts working harder than you do. This is the turning point where wealth building becomes truly powerful. However, this journey is not easy. The stock market is unpredictable in the short term. Prices move up and down daily, sometimes dramatically. News headlines, economic changes, global crises, and investor sentiment all play a role in these fluctuations. And this leads to one of the biggest challenges investors face: emotional decision-making. When markets fall, fear takes over. People panic and sell. When markets rise, greed takes over, and people may invest recklessly. These emotional reactions often lead to poor outcomes. In fact, one of the biggest reasons people fail in the stock market is not because the market fails, but because they do not stay consistent. Successful investing requires discipline, patience, and the ability to think long-term, even when short-term conditions are uncomfortable. Now let's shift to life insurance, particularly permanent life insurance like whole life or universal life. At its core, life insurance is about protection. It is designed to provide financial support to your loved ones if something happens to you. This alone makes it one of the most important financial tools for anyone with dependents or financial responsibilities. But permanent life insurance adds another layer: cash value. This cash value grows over time as you pay your premiums. It acts like a savings component within the policy, offering steady and predictable growth. Depending on the policy, this growth may be guaranteed and may even include dividends. Because of this feature, life insurance is often marketed as more than just protection. It's presented as a financial asset. But here's where clarity is important. Life insurance is not designed to maximize returns. Its growth is typically conservative, often in the range of 3% to 5%. While this is lower than what stocks can potentially deliver, it comes with less volatility and more predictability. This predictability can be incredibly valuable, especially during uncertain times. While stock markets may decline sharply, the value within a life insurance policy tends to remain stable and continue growing steadily. Another important benefit is the tax treatment. Cash value grows on a tax-deferred basis, meaning you don't pay taxes on the growth each year. In many cases, you can also access this money through policy loans without triggering taxes. This creates a unique form of liquidity that can be used for emergencies, opportunities, or even retirement income. Additionally, the death benefit is generally paid out tax-free, making life insurance an effective tool for transferring wealth to future generations. But these benefits come with trade-offs. Permanent life insurance policies are significantly more expensive than other forms of insurance. A large portion of your premium, especially in the early years, goes toward fees, commissions, and administrative costs. This means it can take several years before the policy starts to build meaningful value. And if you exit early, you may lose money. This brings us back to a critical concept: opportunity cost. Every financial decision involves trade-offs. When you put money into life insurance, you are choosing not to invest that money elsewhere, particularly in higher return assets like stocks. Over long periods, this difference can be substantial. For example, a few percentage points of difference in annual return may not seem significant at first. But over 20 or 30 years, it can result in a dramatically different outcome in terms of total wealth. So if the question is strictly, which one makes you rich? Stocks have a clear advantage. They are the primary engine of wealth creation. But wealth is not just about growth. It's also about protection, stability, and sustainability. This is where life insurance plays a crucial role. It acts as a financial safety net. It protects your family. It ensures that your financial progress is not undone by unexpected events. And for many people, this sense of security is just as important as maximizing returns. In reality, the most effective financial strategies don't rely on a single tool. They combine multiple tools. You might use stocks to grow your wealth, savings to manage short-term needs, real estate to diversify, and life insurance to protect everything you've built. Each serves a purpose. Each fills a gap. Another important factor to consider is behavior. Some people are highly disciplined. They invest consistently, stay focused, and ignore market noise. For them, the stock market can be an incredibly powerful tool. Others struggle with consistency. They get distracted, make emotional decisions, or fail to invest regularly. For them, structured systems like life insurance can provide a level of forced discipline that helps them stay on track. So in many cases, success is not about choosing the perfect strategy. It's about choosing a strategy that works for you, one that aligns with your mindset, your habits, and your long-term goals. Because at the end of the day, the best strategy is the one you actually follow. So which one actually makes you rich? Stocks are the engine that builds wealth. Life insurance is the shield that protects it. And when used together intelligently, they create a powerful combination. One that allows you to grow your money, protect your family, and build a financial future that is both strong and secure. That's the real goal. Not just getting rich, but staying rich and creating something that lasts beyond your lifetime. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.